While the financial world remains fixated on the volatility of the S&P 500 or the latest interest rate decision from the Federal Reserve, a silent tectonic shift is occurring in the East. If you look at your screen right now, you might see silver trading at $72 per ounce on the global spot market. To a casual observer, this looks like a standard commodity price. But if you travel to the vibrant streets of the Zaveri Bazaar in Mumbai, you will discover a completely different reality. There, the physical price of silver has surged to 87,000 rupees per kilogram. When you do the currency conversion, that equals approximately $75 per ounce. This is not a minor discrepancy. This is a massive $3 premium that signals a total breakdown in the global pricing mechanism. For decades, the world has relied on the paper markets in New York and London to tell us what silver is worth. But today, the Indian market is telling a different story. It is telling us that the paper price is a lie. The Indian market is screaming that there is a physical shortage so severe that buyers are willing to pay a 15% markup just to get their hands on a physical bar of metal. The data recently released by the Indian Ministry of Commerce is nothing short of terrifying for anyone holding a short position. In the year 2025, India has imported 6,000 metric tons of silver. To help you understand the scale of this move, consider this. The entire world mines approximately 830 million ounces of silver per year. India just swallowed 190 million ounces in a single wave of buying. That is nearly 25% of the entire global annual production consumed by one single nation. We are witnessing the arrival of a massive whale in the silver market. This is not the speculative buying of a few hedge funds. This is the collective force of 1.4 billion people and a rapidly industrializing economy. Usually, Indian buyers are known for being extremely price sensitive. They typically wait for a market crash to buy the dip. However, in 2025, they are buying the rip. They are chasing the price higher with an urgency we have never seen before. They have effectively bought the entire annual output of Peru, Mexico, and Australia combined. While Western investors are distracted by digital assets and tech stocks, the physical silver is being loaded onto planes and shipped to the subcontinent. Once that silver lands in India, it disappears into a black hole. It moves from the visible vaults of the West into the private hands and industrial warehouses of the East. It is a one-way street. This silver is not coming back to the London or New York exchanges. The music has started to fade, and India has just grabbed all the chairs. To understand why 6,000 tons of silver have vanished into the Indian subcontinent, we must look beyond the industrial charts and into the heart of the Indian household. For generations, gold has been the undisputed king of the Indian financial soul. It is more than just jewelry. It is a family bank account and a symbol of prestige. However, a fundamental shift is occurring in the social fabric of the nation. As gold prices climb toward $3,000 per ounce, the yellow metal is becoming an elite asset, drifting out of reach for the average farmer in Punjab or the factory worker in Bangalore. The Indian saver is not giving up on hard assets. Instead, they are moving down the periodic table. They are turning to silver. Historically, silver was dismissed as the poor man gold, but in the current economic climate, it is being rebranded as the smart man savings account. This is not just a change in preference. It is a necessity driven by the volatility of the Indian rupee. With inflation remaining sticky and the currency facing constant pressure against the United States dollar, the Indian middle class knows that holding paper cash is a losing strategy. The entry point for silver is far more accessible than gold. A young professional can now accumulate silver in small, regular increments. But the real game changer has been the modernization of the Indian financial system. Under the new regulations from the Securities and Exchange Board of India, or SEBI, silver exchange-traded funds have exploded in popularity. In the past, buying silver meant dealing with high physical premiums and the security risks of storing heavy bars at home. Today, millions of Indians can buy silver with a single swipe on their smartphones. This digital bridge has unlocked billions of dollars in dormant capital. But here is the crucial difference between an Indian ETF and its Western counterparts. Indian regulations are incredibly strict regarding physical backing. While some Western funds are accused of being nothing more than paper claims, Indian fund managers are required to purchase and vault the actual physical bars for every rupee invested. This means that a retail investor buying 10 ounces of silver on an app in Mumbai triggers a chain reaction that ends with a physical bar being removed from a vault in London. We are seeing a massive surge in investment demand that is no longer seasonal. It is constant. The velocity of this capital is breathtaking. Every month, approximately 500 tons of silver are being pulled out of global liquidity to satisfy this new digital appetite. This is creating a floor under the price that the Western shorts simply do not understand. When a farmer in India buys silver, he is not looking at a chart for a quick trade. He is thinking about his daughter wedding in 2055. He is thinking about a legacy that spans decades. This is the definition of strong hands. The silver is being moved from the weak, speculative hands of New York traders and into the permanent custody of the Indian people. While the investment demand from retail savers is significant, it is the industrial appetite of the new India that is truly breaking the back of the silver market. We are witnessing a structural transformation of the Indian economy. Prime Minister Narendra Modi has launched a massive initiative known as the Production Linked Incentive, or PLI scheme. The goal is simple but ambitious: to break the Chinese monopoly on green energy technology and turn India into a global manufacturing powerhouse. To do this, India is building solar gigafactories at a record-breaking pace. In the state of Gujarat, massive industrial complexes are rising from the ground, designed to produce the next generation of solar cells known as TOPCon modules. These are not your standard solar panels from 10 years ago. TOPCon technology requires significantly more silver paste to achieve its high efficiency. Specifically, these cells use silver to conduct electricity from the silicon wafer with minimal loss. In the world of high-tech manufacturing, silver is not a luxury. It is an essential industrial component for which there is no cheap substitute. Consider the scale of the demand. When an Indian billionaire industrialist commits to building a 10-gigawatt solar factory, he is not just buying land and machinery. He is securing a supply chain that spans the globe. These industrialists are smart. They have watched China implement export bans on critical minerals, and they realize that the global supply of silver is finite. They are not waiting for the price to drop. They are engaging in what I call an inventory panic. These massive corporations are going directly to the London Bullion Market Association to buy thousands of tons of silver bars. They are not speculating on the price. They are ensuring operational security. They know that a $100 million factory is nothing more than a collection of useless glass and metal if they do not have the silver paste required to finish the product. This is why the demand is inelastic. Whether the price is $20 or $75, the silver must be secured. This industrial hunger is creating a permanent drain on global inventories. Unlike jewelry, which can theoretically be melted down and sold back into the market, silver used in solar panels is extremely difficult and expensive to recycle. Once it is laminated into a solar module and installed on a roof in the Thar Desert, that silver is effectively gone for the next 25 years. India is not just buying silver. They are sequestered it. They are building a strategic reserve of the most conductive metal on Earth, embedded directly into their national energy infrastructure. This is a head-on collision between a global monetary panic and a massive industrial revolution. To understand where the global silver market is headed, we must look at the vault data from the London Bullion Market Association, or LBMA. London has long been the primary hub for the world physical silver trade. It is the central clearinghouse where institutional metal is stored and moved. However, the latest reports indicate a crisis of supply. Silver inventories in London vaults have plummeted to their lowest levels since records began. The silver is quite literally evaporating from the Western financial system. Where has it gone? The answer is etched in the shipping manifests of cargo planes heading to Chennai, Mumbai, and Ahmedabad. In the past, silver would flow into London during periods of high prices and flow out when prices dropped. But that cycle has been broken. We are now seeing a massive, one-way exodus of metal. The silver is moving out of registered vaults and into bonded warehouses across India. This is a critical distinction because once silver enters the Indian ecosystem, it enters what we call a black hole of liquidity. In the West, silver is often held in transparent, centralized vaults, where it can be tracked, leased, or sold back into the market with the click of a button. But in India, the metal is dispersed. It is sold to millions of individual households in thousands of small villages. It is transformed into industrial paste for solar factories or electrical contacts for the burgeoning automotive sector. This silver is never coming back to London to satisfy a short squeeze on the Comex. It is permanently removed from the global floating supply. This drain is creating a state of extreme tension in the physical market. We have reports that major refineries in Switzerland and the United Arab Emirates are working 24-hour shifts, 7 days a week. They are struggling to process large 1,000-ounce bars into the smaller kilo bars that the Indian market prefers. The demand is so overwhelming that the logistical chain is reaching its breaking point. There are simply not enough secure transport planes or specialized refining capacity to keep up with the Indian whale. The depletion of the London vaults is a signal that the era of cheap, readily available silver is ending. For years, the market operated on the assumption that there would always be enough metal in the vaults to satisfy any sudden surge in demand. That assumption has been shattered by the 6,000-ton Indian order. We are approaching a moment of truth where the paper contracts traded in New York will have no physical metal to back them up. When the world's largest silver consumer decides to drain the world's largest vault, The result is not just a price increase. It is a fundamental realignment of global wealth. The silver is moving from the hands of those who trade it to the hands of those who value it as a strategic necessity. In a functional global market, a price difference of $3 per ounce between two cities should not last more than a few hours. This is the basic principle of arbitrage. Theoretically, a trader could buy silver in New York for $72, put it on a plane to Mumbai, and sell it for $75. After covering the shipping and insurance costs, they would walk away with a guaranteed profit of nearly $2 per ounce. If you do this with 1 million ounces, you make $2 million for a few days of work. So, why is this gap not closing? Why is the price in New York not rising to meet the reality in Mumbai? The answer lies in the total breakdown of the global silver logistics chain. The pipe is clogged. First, there is a severe shortage of specialized refining capacity. The Indian market demands high-purity kilobars, but much of the silver sitting in Western vaults is in the form of large 1,000-ounce bars. Every refinery in the world capable of casting these kilobars is currently booked out months in advance. You cannot sell what you cannot refine. Second, the physical transport of precious metals is facing a security and insurance bottleneck. You cannot simply ship 10 tons of silver on a standard commercial flight. It requires armored transport, high-level security, and massive insurance premiums. Currently, the volume of silver moving toward India has exhausted the available capacity of secure logistics providers. Even if you have the silver in London, you might wait weeks or months for a secure slot on a transport plane. Furthermore, the Indian government regulatory environment adds another layer of friction. While the demand is high, the bureaucratic process of moving metal through Indian customs into the Gift City Free Trade Zone is notoriously complex. Traders are reporting that metal is getting stuck in customs for 10 to 15 days. In a volatile market, a 2-week delay is an eternity. No rational trader will buy silver in New York and wait 3 weeks to sell it in Mumbai, when the price could collapse in the meantime. This logistical friction means that the Mumbai price has decoupled from the global spot price. The price you see on your digital screen in the United States is becoming irrelevant to the physical buyer in the East. This is a nightmare scenario for the paper markets like the Comex. Their pricing power depends on the ability of the market to deliver physical metal to close price gaps. When the logistics fail, the paper price becomes a hollow number. The Indian whale has not just bought the silver. It has broken the mechanism that the West uses to control the price. We are moving into a period where the physical reality of a bazaar in India carries more weight than the digital algorithms of a bank in Manhattan. As the silver drain intensifies, whispers have begun to circulate through the corridors of power in the global bullion markets. Traders in Dubai and Singapore are talking about a specific and highly disciplined entity operating out of the Gift City Free Trade Zone in Gujarat. This entity is known in elite circles as Unit 939. While its official registration remains shrouded in bureaucratic layers, its impact on the market is undeniable. This is the hand of the whale, and it is moving with surgical precision. Unit 939 appears to be operating with a mandate that goes far beyond simple commercial profit. This entity has been observed sweeping the market for large industrial bars, often bypassing the traditional dealer networks and buying directly from refiners before the metal even reaches the open market. The sheer volume of these transactions suggests that this is not a private hedge fund or a group of speculators. The scale points toward a state-backed operation or a consortium of India's most powerful industrial families working in coordination with national strategic goals. Why would a nation-state create such a shadow player? The answer lies in the concept of strategic stockpiling. The Indian leadership has seen how China cornered the market for rare earth elements and lithium. They have learned that in the 21st century, mineral security is national security. By using an entity like Unit 939, India can accumulate a massive strategic reserve of silver without triggering an immediate panic or a parabolic price spike that would hurt their own domestic industries. This is a game of quiet accumulation. They are front-running the global shortage. They knew that the Chinese export bans on critical materials were coming, and they moved to lock in their supply before the rest of the world realized the door was closing. If the reports are accurate, Unit 939 has secured thousands of tons of silver that will never see the light of day on a public exchange. This metal is being funneled into high-tech manufacturing and national defense applications. The existence of such a player changes the fundamental calculus for silver investors. It means that the floor under the price is not just supported by jewelry or retail investment, but by the sovereign will of a rising superpower. When a nation decides that a commodity is a strategic imperative, the traditional rules of supply and demand are rewritten. You are no longer trading against a bank or a fund. You are trading against a government that is determined to ensure its industrial survival for the next 100 years. The presence of Unit 939 is a signal that the silver market is no longer just a financial market. It is a geopolitical battlefield. For over half a century, the global price of silver has been determined not by the exchange of physical metal, but by the trading of paper contracts on the Comex in New York. In this digital casino, banks and hedge funds trade millions of ounces of silver that do not actually exist in physical form. It is a system of leveraged bets, where the volume of paper silver often exceeds the total world mining production by a factor of 100 to 1. For a long time, this system worked because most participants were happy to settle their trades in cash, rather than demanding the actual metal. But the Indian whale has just thrown a massive wrench into this digital machinery. We are now witnessing what economists call a great decoupling. The link between the digital price on a screen and the physical reality of a silver bar has snapped. While the algorithms in Manhattan are programmed to sell silver whenever the dollar strengthens or interest rates rise, the physical buyers in Mumbai are doing the exact opposite. They are ignoring the digital noise and focusing on the tangible reality of empty shelves and delayed shipments. This creates a dangerous situation for the bullion banks. These institutions have sold massive amounts of paper silver to suppress the price and manage their risks. They rely on the assumption that they will never have to deliver the physical goods. But as India drains the global vaults, the pool of available metal to back these paper claims is shrinking to dangerous levels. We are approaching a moment where a single large entity could stand for delivery on the Comex and find that the vault is empty. When the paper market loses its connection to the physical market, the result is usually a violent revaluation. We saw a preview of this in the nickel market in 2022, when prices doubled in a single day because of a massive short squeeze. Silver is far more critical to the global economy than nickel, and the Indian demand is far more structural. The algorithms are currently fighting a war they cannot win. You can print an infinite amount of paper silver, but you cannot print a single atom of physical silver. The traders in the Zaveri Bazaar understand this. They are laughing at the New York spot price because they know it is an illusion maintained by banks that are increasingly desperate. Every time the paper price dips in New York, it only serves as an invitation for more Indian buying. They see the lower price as a gift, allowing them to drain even more physical metal at a discount. The tail is no longer wagging the dog. The physical market, led by India, has taken control of the narrative. The era of paper price discovery is dying, and the era of physical price reality is being born in the East. The massive accumulation of silver by India cannot be viewed in isolation from the broader geopolitical shift occurring within the BRICS alliance. We are currently witnessing a coordinated effort by the Global South to insulate their economies from the hegemony of the United States dollar. While much of the headlines focus on gold, silver is emerging as a critical secondary pillar in this new monetary architecture. For India, accumulating 6,000 tons of silver is not just a commercial move. It is a strategic hedge against the weaponization of the Western financial system. As India moves toward becoming the third largest economy in the world, its leadership recognizes the inherent danger of relying solely on a fiat currency managed by a foreign central bank. By converting their paper dollar reserves into hard, physical assets like silver, India is effectively creating an internal insurance policy. In the event of a global currency crisis or a collapse in the dollar-based trade system, the nation that holds the physical metal holds the power. This is the essence of de-dollarization. It is about moving from debt-based assets to commodity-based assets. There are persistent discussions within the BRICS working groups regarding the creation of a new unit of account backed by a basket of commodities. While gold would serve as the primary anchor, industrial metals like silver and copper are being considered for their intrinsic utility. Silver is unique because it possesses the dual characteristics of a monetary store of value and an indispensable industrial raw material. If a BRICS currency initiative includes a resource-backed component, India Silver Hoard will give them massive leverage at the negotiating table. Furthermore, the Indian government is looking at silver as a way to back its own central bank digital currency, or CBDC. By having a massive strategic stockpile of silver, the Reserve Bank of India can provide an implicit guarantee of value for the digital rupee. This creates a bridge between the ancient tradition of metallic wealth and the future of digital finance. It allows the Indian economy to grow with the speed of software while being anchored by the stability of hard metal. The 2025 silver order is a clear signal that India is no longer willing to play by the rules established in Bretton Woods. They are loading the boat with physical assets before the inevitable revaluation of real goods versus paper promises. While Western central banks are trapped in a cycle of printing more debt to service existing debt, India is quietly building a fortress of silver. They are preparing for a world where the strength of a nation is measured not by its credit score in Washington, but by the weight of the metal in its vaults. As we move deeper into the final quarter of 2025, the global silver market is entering a phase of pure psychological acceleration. To understand the gravity of the current situation, we must look back at the most famous attempt to corner this market, the saga of the Hunt brothers in 1980. Back then, two wealthy oil tycoons managed to accumulate approximately 100 million ounces of physical silver and millions more in futures contracts. Their buying spree drove the price from $6 to nearly $50 in just 1 year. It was a massive move that ended in a catastrophic collapse when regulators changed the rules to break their momentum. However, what we are witnessing today with the Indian whale is fundamentally different and far more dangerous for the shorts. The Hunt brothers were individuals using leverage. India is a nation of 1.4 billion people using their collective savings. While the Hunts held 100 million ounces, India has just imported 190 million ounces in a single year. We are no longer talking about a speculative corner. We are talking about a structural drain. The next phase of this panic will be driven by the industrial users. Right now, companies like Tesla, Samsung, and massive solar manufacturers in the United States and Europe are watching the Indian inventory numbers with growing alarm. Elon Musk recently signaled on X that the rising silver price is a critical concern for manufacturing costs. These companies operate on just-in-time inventory models. They do not keep months of silver paste sitting in their warehouses. They rely on a steady flow of metal from the global supply chain. When the news finally breaks that the London and Comex vaults are essentially empty, we will see the mother of all short squeezes. It will not be driven by Reddit traders or retail speculators. It will be driven by procurement officers at Fortune 500 companies who are desperate to keep their production lines moving. They will pay any price to secure the physical metal because the cost of shutting down a gigafactory for 1 day is far higher than the cost of silver at $100 per ounce. We are entering the vertical phase of the price discovery process. In the coming months, we expect to see reports of delivery delays, canceled orders, and emergency surcharges in the physical market. The $3 premium we see in Mumbai today is just the beginning. As the shortage becomes global, that premium will expand. We are looking at a potential scenario where silver reaches triple digits in 2026. The math is simple. A fifth consecutive year of structural deficit combined with a 25% demand shock from a single country equals a price explosion. The inventory panic is no longer a theory. It is a mathematical certainty. The window to acquire physical silver at any price below $100 is closing fast. As we stand at the threshold of 2026, the 6,000-ton Indian silver order will be remembered as the moment the old financial order finally cracked. We are not just looking at a spike in a commodity chart. We are witnessing a historic transfer of wealth from the West to the East, and from paper promises to physical reality. For decades, the Western financial system has treated silver as a forgotten relic of the past, a secondary metal that could be easily manipulated through digital leverage. But the Indian whale has proven that in a world of tangible needs, physical metal is the ultimate arbiter of power. The implications for the average investor are profound. We are entering an era of price discovery that could see silver challenge targets of $100 or even higher. Major financial institutions like Bank of America and Citigroup have already begun revising their 2026 targets upward, with some aggressive technical models suggesting a move toward triple digits is no longer a fantasy but a mathematical probability. The structural deficit, now in its fifth consecutive year, has reached a tipping point where supply simply cannot respond to the accelerating demand from green energy, artificial intelligence, and national strategic stockpiling. So, what is the strategy for the individual investor? The lesson from Mumbai is clear. Ownership is everything. In this new landscape, a paper claim on silver is becoming increasingly dangerous. If you do not hold the physical metal, or at least have it in a direct, fully allocated vault, you are exposed to the systemic risk of a Comex default. You do not want to be the one holding a bag of worthless paper currency when the world's largest industrial users are scrambling for the last remaining bars of physical metal. You should view silver not as a short-term trade, but as a strategic imperative for your own portfolio. Like the Indian grandmother buying a bar for her grandson, or the billionaire industrialist securing his supply chain in Gujarat, you must think in years and decades, not days and hours. The volatility will be extreme. There will be days when the paper markets try to shake you out with sudden price drops. But when those moments happen, remember the planes landing in Mumbai. Remember that the flow of metal is one way. The Indian whale is not betting against the dollar. It is simply moving to a superior form of collateral. As the world transitions to a new monetary and industrial era, silver is reclaiming its throne as the indispensable metal of the future. The opportunity to swim alongside the whale is still open, but the window is closing. The 6,000-ton wake-up call has been issued. The question is, are you awake, or are you still holding the paper? I am Jeff. This is Boring Metals. Class dismissed.